So there's always been a lot of chatter about EBITDA, but what exactly is this and what is it used for in finance? So EBITDA is the acronym for earnings before interest, taxes, depreciation, and amortization. EBITDA is a widely quoted performance metric that measures profitability and is often used as a loose proxy for cash flow generated during an accounting period. For years, there's been an ongoing debate over this metric and whether it has a place in finance, so let's dive into what this is and what it isn't. Now, by definition, EBITDA is an income statement metric that's used to assess operating performance by adding non-operating expenses back to net income. The four standard non-operating expenses in this calculation are interest expense, taxes, depreciation, and amortization, and therefore by adding them back to net income, this allows us to make apples-to-apples comparisons over time and across companies. Now, furthermore, because EBITDA includes non-cash expenses and think depreciation and amortization, it's commonly used as a loose proxy for the cash flow generated during an operating period. Now, let's get into what EBITDA is not. So EBITDA is not recognized by US or international accounting standards, and Warren Buffett himself has long been an outspoken skeptic of this metric. Buffett doesn't like EBITDA because he believes it's too hypothetical and that it can be used to give the appearance that a company is profitable and generating cash when in reality it isn't. Now, while Buffett's concerns are real and are grounded in a deep understanding of financial analysis, EBITDA is still widely used in the industry, and for this reason, it's important for accounting and finance professionals to understand it. EBITDA has a wide range of applications in lending, valuation, and in financial reporting. Lenders and credit analysts use EBITDA to project how much cash a business will generate to make required principal and interest payments on a loan. Appraisers and investment bankers use EBITDA to create a value for and sell businesses. And managers of capital-intensive businesses often use EBITDA to describe operating performance when communicating with investors. EBITDA can be calculated by using a bottom-up or a top-down approach. Now, like the name implies, the bottom-up approach starts at the bottom with net income and adds back interest, taxes, depreciation, and amortization. So this is what we've been talking about throughout this lecture so far. Now, we can also do this using a top-down approach by starting with revenue. So we'll start with revenue, and then we'll subtract cost of goods sold and cash operating expenses to arrive at EBITDA. Now, notice that I said cash operating expenses and not all operating expenses. And you should ultimately come to the same calculation, whichever method you use. Now, lastly, there are two EBITDA calculations that you should be aware of, including the unadjusted EBITDA and the adjusted EBITDA. So unadjusted EBITDA is simply the standard EBITDA calculation we discussed on the previous slide, and adjusted EBITDA takes this calculation one step further and also adds in non-recurring expenses and other discretionary expenses. These expenses are commonly referred to as add-backs, and some common examples of add-backs include losses on equipment sales, M&A expenses, unusually high legal costs, and so on. Now, when businesses claim add-backs in addition to interest, taxes, and non-cash expenses, adjusted EBITDA will be higher than unadjusted EBITDA. Let's take a moment to apply what we just learned in our fictional private company example. All right, so we're back in the Lincoln Bike Parts P&L, and this time we're going to use a bottom-up approach to calculate EBITDA. Now remember, the bottom-up approach follows the EBITDA acronym, so we have earnings plus interest plus taxes plus depreciation and amortization. So we're going to start out this calculation with net income of $93,192, and then we'll add in interest expense of $24,141. Just briefly, as a limited liability company or an LLC in the United States, this entity actually doesn't report any corporate income taxes, so in this instance, taxes are zero. Next, we have depreciation of $52,082 and amortization expense of $7,000. And when we total all this up, we get unadjusted EBITDA of $176,415. So let's take this example one step further and also calculate adjusted EBITDA. Now remember that adjusted EBITDA is just simply unadjusted EBITDA plus non-recurring expenses. And when we take a look at this P&L, we see that the company has a one-time expense of $30,250. So let's assume that this expense was due to fire damage. So to complete this calculation, we'll add this expense to unadjusted EBITDA, resulting in adjusted EBITDA of $206,665. Now, you can also come to these same figures using a top-down approach, and I encourage you to attempt this calculation on your own time to further solidify this concept. To do that, simply reference the formula on the previous slide, and if you have any questions, go ahead and leave a comment below and we'll open it up for discussion. In the next video, we'll discuss common-sized income statements.